Last week's 50 basis point rate cut is the latest sign that the Fed is targeting a soft landing and that inflationary concerns are more under control here. So, how should you be positioning your portfolio in this current economic environment? Here with more, we've got Liz Miller, who is the Summit Place Financial Advisors founder and president here. Liz, great to have you on the program with us. So as you think about your own thesis for positioning now that the Fed rate cut cycle has begun, where have you started to rotate?
So the pivot, as we're all saying, is great. And it confirms that the Fed is now thinking about growth as much as inflation, or maybe more so. And that's what investors want to hear. They want to hear that, the central government is supporting growth in our economy, which leads to growth in their portfolios. So far this year, we saw the early part of the year really led by, we know, the mega cap techs, and they've held up fine. But what we're going to see now, and we've even started to see in the last week or two, is that some of these other sectors that are more interest rate sensitive are going to start doing better, like housing and rentals and financials and consumer goods that really were struggling in the market the first part of this year.
I can't get a few stats out of my head. One of them from Ryan Dietrich specifically, that's looking at the amount of moves that we've seen, continued moves higher after and as the Fed kind of begins their cutting cycle. And in the past, when they've begun their cutting cycle anywhere within this 1% of all-time high range, we tend to see a rally even thereafter, setting some new all-time highs of about 14%. And so with that in mind, what would you position yourself in order to see your own perhaps benefiting from some of the more outsized sectors that could stand to benefit the most in that continued run-up?
Yeah. Well, first, I do want to say that when we talk about the market at all-time highs, we're really talking about the S&P 500, and it's very skewed right now by those mega cap tech stocks. When we look at other sectors, they aren't making all-time highs. And our last high in the market was really December 2021, before 2022 was dismal. And we're constantly looking at what sectors have made new highs 2 years later, 2.5 years later. So this market has really been pretty flat under the covers for a long time. So we see plenty of upside to come. One sector we like a lot is the real estate sector that certainly also has rebounded from its bottom in anticipation of rates, but is nowhere near its previous highs.
It's interesting, especially as we've been having some conversations with strategists throughout the morning, the number of people that are looking internationally and seeing where there could be a little bit of pressure, and specifically within China as well. If some of the efforts to make sure that they are buoying and restoring the economy there, if they're unsuccessful, then that could have a broader impact into some of the U.S. companies. What are you monitoring there, and how are you kind of tracking that trade, especially knowing that we could see some more potential cuts to come in that region and the rate policy?
When we think about China, what we often talk about is China helps define the global pie. When China is growing, the global pie for everyone is a lot bigger. And so their slice just naturally grows. When China is struggling, they don't inflate further that global pie. We're all dealing with our own contributions to global growth. And that's where we stand today with a somewhat stalled China. Very bold moves yesterday, but I think investors are still skeptical to see, is this going to not only help the real estate sector in China, but what's really needed is to get consumers in China to regain their confidence and start spending again. We look at luxury goods as sort of one of the easy views on what's China spending. We own a lot of multinationals, from Apple to Nike, that all do better when China is doing better. So we see this in small ways in a lot of US investments too, and we're tracking that sort of company by company along with those broader policies.
While we've got the swoosh up on the screen right now, I understand that Nike is one of your leading picks here. Take us into the thesis there. The company just had and is about to see the changeover at the executive level. CEO Elliott Hill going to be coming in mid-October. What's your anticipation there?
This is definitely a turnaround story in terms of the fundamentals, but Nike is one of the most valuable brands in the world, and the stock has not done well. It's been on a continuing decline over the last year plus from a nice high, and that's on a lot of missteps internally. When that's the case, then you know you can turn it around. It's a valuable brand, and a lot of runners and athletes still look for their performance goods. But they've really missed the boat in letting other companies get into that space, and focusing sort of on the collectibles shoe market has been a real distraction there. So we're looking forward to new leadership, helping them regain their position that they've long held as a sporting goods technology company. And they will get an extra boost as China improves, as you said, if that happens. But even still, there's so much upside in this company today just from improving their own internal operations.
Liz Miller, who's the Summit Place Financial Advisors founder and president. Liz, thanks so much for taking some time here with us today.
Thanks.